And with that, see, what do you have for us?
Thanks, Alex. Hi, everyone. Thanks for joining us for an hour or so to discuss the markets. Let me switch to the next slide. Uh, Over the next kind of 10, 11 slides, maybe 20 minutes, I'm just going to run through some of these points that I'm highlighting here by sharing some deeper insights through the slides themselves. I just got the pointer working. I think the biggest takeaway from this slide would be that to anyone who thought that the Republican Party would reduce spending, we certainly didn't think so because there was evidence previously that that wasn't going to be the case. I think we now know that spending more and raising deficits is a bipartisan, has bipartisan support. We were on a pretty unsustainable path. This budget, the one big beautiful bill, is making it even at a higher scale. So I think that would be the kind of takeaway if there was one thing out of this slide. Just to level set, I'm putting a chart of what Alex had in a single slide. I think the big takeaway would be, year to date. So this is as of last evening. Year to date, gold and Bitcoin are leading US small caps and the bond. So the AGG is the aggregate bond index. And these are price returns. It doesn't take into account some of the yield and the dividends, but broadly similar. And we'll dig into some of those asset classes further down the road. Going back to the issue of federal spending deficits, what I would say is, what this chart shows is how since the global financial crisis, so the global financial crisis was down here, the deficits have really spiked higher. And, we are no longer in a crisis. This is COVID right here. We have really escalated our spending, and sadly, now the crisis is well behind us. The economy is doing great, but the last year, $1.8 trillion deficit was the highest deficit outside of a crisis or a war year. And, we've just normalized these levels. There's the question of who will buy our debt. Currently, about 30% of our debt is owned by foreigners. I mean, there's always going to be buyers. The question is how much, what would be the rate that would attract buyers into this asset class? And these are two questions that remain. I don't think anyone has an exact answer, but it's something we think about in terms of our allocation to bonds and just overall constructing client portfolios. This is just a different look, right? Under the old law, before the one big beautiful bill, the deficit was always going to increase. We had the House pass the budget, and it went up to 124%. And this is by 2034. When he went to the Senate, came out of the Senate, it went up some more, which is the final version of it. But there are, as you know, some temporary measures like no taxes on tips. So if those are made permanent, you're going to end up with a budget deficit of 130%. Now, everyone thinks, or most people think that that is a big number. But I ask the question, if you look at Japan, Japan has a debt to GDP ratio of 236%. They've not blown up. Now, could the US, just do just fine? What I would say is Japan's debt is funded entirely by the domestic market, meaning Japanese own that debt. They do not rely on foreigners. So that's the challenge for the US. The second part, even more important, is that the Federal Reserve of Japan, or the Central Bank of Japan, called the BOJ, Bank of Japan, owns more than 50% of the government debt. Now, in contrast, the current Federal Reserve owns about 11% of all the debt outstanding, and almost all of that was accumulated during COVID when the term QE or money printing took place. And the Fed, in fact, have been reducing their holding of treasuries over the last, when rates went up, they've been reducing it. So it's possible that the Federal Reserve has to do this, but if it does come in, it probably means pretty serious implications for, possibly inflation, with how the assets perform, and we can discuss a bit more. And maybe you're already seeing that in terms of how gold and Bitcoin have done this year. Looking at the economy, I mean, the stock market's at an all-time high, and it's fair to say the economy is doing just fine. And I always look at, it's more than 70% of GDP is consumption. How is the consumer doing? And one of the things I constantly look at is what's happening to domestic airline travel, because this is quite the discretionary item, because you don't have to go on holiday. And this is a chart of TSA checkpoint throughput, and the 2025 number is right here, so it's tracking just in line with 2024. I would probably say it's probably modestly softer than 2024, because you have seen the big airlines have announced capacity cuts for this year compared to the start of the year. And if you look at the inflation data, airline prices are deflationary. They're coming down. So if things were stronger than last year, you would think capacity would go up and prices would go up. Those are easing somewhat, but I think overall this speaks to a very robust consumer and an overall economy. The other area I want to flag is credit spreads. What does that mean? Basically means how much it costs a company to issue debt over how much the US is borrowing, Uncle Sam's borrowing, meaning over the US Treasury rate. And we're now again back at near historic lows, meaning companies are flush with cash, they have easy access to debt, all of which helps economic growth and the liquidity in the system, which certainly helps where risk assets, meaning stock prices and other risky assets, are trading today. So on the economic front, things are looking good. I had to look hard to find an area where things are looking, I wouldn't even call it dicey. Things are kind of weakening ever so modestly. And this is I'm looking at something called the warn notices. So if you're a company that employs more than 100 people and you want to lay people off, you have to file what's called a warn notice, or it's from the act. I believe it's filed with the Labor Department. And so there's this ever so modest increase. And, really nothing to worry about it, because it spiked much higher in 2022 when interest rates went up. And if you said, oh, look, this is definitely going to be a recession, with the benefit of hindsight, we know, no, that assumption or that assertion expectation was incorrect. So, I mean, I think I'm pulling at a string here to say, like, okay, it's something we're watching, but really hardly anything to worry about with regards to employment and labor. An area where there is no debate, I would argue, is speculative activity. This is a chart of the yellow line is S&P, GS up here is Goldman Sachs, and they have a basket of companies that are unprofitable, or no profit or loss-making tech companies, and they also have a basket of stocks that are called meme stocks, meaning they don't even have a business model, leave alone profits. It's not inconceivable that a good company may not have profits temporarily or at the early stages. Meme stocks just don't even have a business model. And as you can tell, we all know the S&P has done well, but look how much better the meme basket and the unprofitable tech have done. So I think this is one area where there shouldn't be any debate. The question is, what's the signal? Does that mean, oh my God, there's going to be a market top soon? No. I think there is not much of a tradable signal. This could go on for another 2 months. It could go on for 2 years. It could go on for 3 years. So it's something we pay attention to, but it's also not something we rush out and do anything with. The other interesting part is, we all know stocks are at all-time highs. This is a chart, and I apologize, and I'll explain this because it's not the clearest chart. This is earnings, S&P 500 earnings, and stocks have gone up to all-time highs when earnings have been cut very sharply, which is unusual. And this top level here is 17%, and the bottom here is about 4%. So Wall Street analysts got it wrong. They do this often. They just followed the crowd. Excitement at the start of the year. The S&P 500 was supposed to grow. They estimated earnings was going to grow for 2025 by close to 15%. That seemed fairly unusual. Well, not unusual. It seemed unlikely. And then we had the tariff uncertainty, all that. Then Wall Street cut earnings down to about 4%. And now that was probably too much, or, and you're already seeing earnings going up. We're in the middle of 2Q earnings, and earnings appear to be coming in better than these forecasts. We're probably going to go up. We're unlikely, highly unlikely for 2025 that we get back up to 15%. It's more likely we settle somewhere in the high single digits. This is 10% here. But it is still, you started the year at 15%, you maybe go down to 10%. And it's, again, unusual that you have stocks kind of brush off falling earnings or lowered earnings and then head right back up to all-time highs. So again, a little area. I think this ties in with what Alex was saying, right? This is not an area where you're getting bargains to go in and increase risk exposure, but it's an area to be like thoughtful and maybe take a few chips off the table. For those of you who have joined this kind of quarterly webinar, this is a slide you should be very familiar with. I put this up all the time. There is no debate about it. This is valuation, the PE ratio, which is basically price over earnings. Or if you think about a whole company, the company's market cap divided by the profits. And the orange line is the S&P 500, which is market cap weighted. This is where all the Mag 7 companies have a high weighting. It is not, it is above the last 15 years trading range, that box that's shown here. And it's not nearly as high as where it was in 2001 before the sell-off. But, certainly something to take note of. What is more interesting, or in a more reasonable valuation, is the blue line, which is the S&P 500 equal weight, meaning you take all 500 companies in the S&P, and there's an index and there's a ETF of this, and each of those stocks is weighted the same amount. So Apple and Nvidia the same weight as Boeing, or even smaller companies in the S&P, and that's at a more reasonable 18, almost 19 times earnings within that trading range. Sure, it's not at the lowest level, but within the range. So, and as we'll discuss further, valuations are better in some of the value defensive areas of the market. We're going to end up just talking about some of the alternatives. And this is a chart that shows the long-term interest rate. Like, this is a 10-year real interest rate derived from the TIPS, the Treasury Inflation Protected Securities Market. And as the history shows, this goes back to the early 90s. When interest rates went up, gold sold off. And this chart is inverted. So as this orange line drops, that means the interest rate is rising. And so when interest rates fell in this period here in the early 2000s, gold followed up. And what we have seen is that as interest rates have gone up, you've seen gold totally ignore that prior kind of correlation and read up to all-time highs. And this is significant because if you looked at April, typically when stocks sell off, you have bonds, the treasuries, US treasuries are a safe haven. Those bonds prices rally. We did not see that in this April. You generally expect longer term bond prices to go up. In fact, stocks sold off and longer term bond prices came down along with it. And one of the only things that actually was a safe haven and supported portfolios was gold. And so just pointing out how there has been a fundamental change in how gold is changing. It could be the elevated geopolitics, tariffs, um, unsustainable debt. You know, there's a bunch of reasons, I suppose. And I want to show this because we've talked about this particular area, and this is just a chart of showing how this is U.S. dollars as a percentage of global central bank reserves. And so it's kind of come off a little bit. And if you look at the gold, partly because of the gold price in US dollars, the gold share has actually gone up. So just keep this in mind. It's certainly something to consider in this kind of new environment we're in. The second asset I want to talk about is Bitcoin. Much shorter, 16-year history, far more volatile. But what is clear is more broad mainstream adoption. So IBIT is the iShares Bitcoin ETF. It's the largest ETF. And this is a chart showing it got to $80 billion in assets. So people bought $80 billion of Bitcoin through IBIT in a record 374 days. VOO is Vanguard's S&P 500 ETF. To get to 80 billion, it took 1,800 days. IEFA is the international stock ETF, and IEMG is the emerging market. It just kind of shows you. So I think the takeaway would be, hey, this was clearly a fringe asset 5 years ago. It is now, as of January, the ETFs were launched in January 2024. It's connected into the broader financial ecosystem, and there is pretty rapid adoption. And if you look at the holdings list, very well-known, well-regarded mainstream financial firms are showing up as owners of there are about 7 Bitcoin ETFs. Overall, I think it's over $100 billion has flowed into this, the Bitcoin ETFs over the last, little over a year and a half now. So this is kind of our concluding slide. And I think the takeaway, as you heard from both Alex and I, is that at the moment, liquidity is ample, both from government spending, because the deficit spending is a short-term stimulus, even though it might have issues in the distant future. It's papering over any geopolitical and tariff risks. They've not gone away. It's there, lingering in the background. But markets are at all-time highs. Rebalancing of stocks as stocks continue to rally into some of the more defensive areas, into the second bullet point, right, into international. It's already done well. It is certainly an area that will continue to benefit if the US dollar continues to weaken. The US dollar has weakened substantially. And that's an area we think, we could see ourselves adding incrementally. Rebalancing into defensive, as one of the earlier charts shows, it is a under-owned, lower or less expensive, lower PE area. An area that's interesting is, small and mid caps are more exposed. We're not thinking about adding, but we're acutely aware that if there is a sharp reduction in interest rates, especially if interest rates fall while the economy is robust, small caps are the ones that benefit the most. So, something that's watched, all this talk about Powell being taken off and somebody more dovish coming to the Fed, it's something that we will continue to monitor. On the fixed incomes, meaning bonds, right? You get fixed income every quarter or every month. We like to be fairly diverse between TIPS, again, Treasury inflation protected securities, short-term treasuries, and intermediate term treasuries. The intermediate portion is, if there was a slowdown in growth, that's where you think intermediate treasuries will actually go, the price of the bond could actually go up. In high yield or junk bonds, we want to be selective. As that credit spread chart showed, you're just not getting compensated for the additional risk of owning a lower credit rated company. It's great for companies to issue because they're getting very low, paying low interest rates, but not necessarily for us to own it. But so we want to be selective there. And finally, with higher deficits, I would argue that geopolitics has gotten worse, and it's probably a structural trend over the next several years that gold and Bitcoin are worth considering as strategic hedges. Gold's already shown its colors, like superior colors, over this April. And as I said, at the moment, those two assets are the best performing year to date. But particularly with the more volatile assets, you want to take a longer term view because the short term volatility, it's not something you want to own for another 6 months. You want to be committed for 5 years plus. And Start off with bonds, right? We own a lot of this. We wouldn't necessarily say, oh, you want to own bonds for the next 20 years. But in our Fortress financial plans, this gives you security of income. And depending on our client and the plan, we would own bonds for cash flow to match with your income needs. And yeah, I'm going to stop there.